appraisal techniques. We usually have two types of techniques. One is the non-discounted cash flow technique, and another one is discounted cash flow techniques. Under this, we would have payback period and ARR, accounting rate of return, or return on capital employed, or return on investment. Under discounted cash flow techniques, we have NRV and internal rate of return. So for today, we'll be specifically looking into NRV. So before we go into net present value, this is just a basic format of net present value. So as given there, NPV is net present value. Here, it's usually calculated by taking into cash flow items, and the format is usually like this, where we take the sales minus any cost related to the getting the investment, like variable costs, and we look at incremental fixed costs, any incremental fixed costs or any contribution loss because of investing in this project instead of another project, and then from there we get the operating cash flow or the taxable profit, which we then have to tax it at the tax rate given in the question. And then we put in the initial outlay, which is how much money, capital, do we put into the investment, and if there is any scrap value that we can get at the end of the investment. And this is the tax benefit for the capital investment. So can we get any tax benefit? And this is the incremental in working capital. So we'll look at each of these in more detail later on, but this is roughly the format for calculating net present value. Okay, so now we're going to look specifically into each items. Look at some potential areas that students might find it quite difficult to solve, or some areas that they're not sure how to tackle it. So we're going to look at some potential areas here one by one, so that when we do the questions, it should be a piece of cake. Okay, so now one of the first potential area is knowing which cash flow to include in NRV calculation. Which cash flow is relevant or not relevant? So as we know, only relevant cash flow is included. Relevant, when I say relevant, I mean relevant to the investment. Like the cash flow is a result of the decision taken to invest in that investment. Okay, so first off, we only include future cash flow, meaning we do not include any sunk or historical costs. For example, like market or research costs. Because when you decide, for example, before you decide to invest in a project to produce flying cars, for example, so you conduct a research with your scientists to see whether you all are able to produce a flying car or not. So this cost is already incurred before you decide you actually spend money to actually produce the car. Because regardless of whether this research, whether the research is successful or not, you already incur the cost for the research, regardless whether you will actually be making cars in the future or not. This is cost before the investment. So regardless of the result of the research, it does not affect, it is considered to be before you invest. Okay, so no matter the decision that you take, whether to invest or not invest, it's already paid for. So because of that, it is a sunk cost. So sunk cost is not included. So is overhead. Overhead is not to be included because, for example, your company is having many projects, not just this one project that you're calculating NRV for. So, and you have a finance department where you pay all your staffs and all, and these staffs are not directly working in this project. Regardless whether you choose to invest in this project or not, that overhead cost can be allocated to other projects or other products. So overhead is not to be included because it is not specifically for this investment. It is not specific to this investment, so hence it is not a relevant cash flow. And we only include cash flow items in NRV calculation. So is depreciation to be included? No, because when you depreciate your asset, you don't actually, for example, your asset is depreciated by 20k, you don't actually go to the bank, take out the 20k and pay someone the 20k. It's just a paper figure. You don't actually pay someone, so it's not a cash flow item. And is opportunity cost to be included? Yes, it is, because for example, you choose to invest in this project. Let's say you invest 2 million in this project, and there's another project where you need an extra 1.5 million, a different project, and if you were to invest in another project as well, you could have gotten 3 million profit, but you only have enough money to invest in this project. So because of that, you lose out on that 3 million on another project. So it is an opportunity loss because you decided to invest in this project. So because it is due to this project, it is relevant cost to this project, so we include opportunity costs. Okay, so these are the relevant cash flow items. Okay, is interest cost to be included when calculating NRV? For example, they say your company gets a 10% interest loan on a 10 million loan. So that means interest cost would be 1 million. So your interest cost would be 1 million. So is this cost to be included in NRV? The answer is no. This is because interest cost, when your company choose to invest in this project, we have like the format I showed earlier. There, this format. Okay, so in this format, can you see discount factor? The discount factor will include the interest cost in it. It will tell you by how much must the cash flow be deflated because of the inflation. So because of that, interest cost is already included in the discount factor. The discount factor will include all the finance costs that is incurred by the company in order to invest in this project. So it will include the debt financing and equity financing. The finance cost because of using the capital or issuing capital, issuing shares to get money from shareholders or from many other banks. So it's not just specifically that it's not specifically like that 10% that 10% loan only. The company gets loans from many banks. So all of the loans, all of the finance cost is included in the discount factor. So to include it here in the interest cost section, as interest cost, will be to calculate the 1 million twice if you were to include it. That is why interest cost is not included, because it's already included in your discount factor. Okay, so moving on. Okay, so sometimes questions will give you they might include inflation in your question. So wait, let me just adjust this. Price. Okay, so they might tell you your selling price in year 1 is $10, year 2 is 15, and year 3 is 20. But you must remember that this is in current price. Current price refers to year 0. Year 0. So this is the $10 is for the current price, is for the price in year 0. So it's not exactly the year 1 price. Okay, so we'll have to change that. Okay, and then they also tell us that inform that the selling price will increase by 10% per annum. So the selling price will go through inflation. It will increase every year by 10% per year. Okay, so how do we calculate the selling price that we must include to be used in NRV calculation? So it's pretty simple. You just list down selling price. In the current price is 10, 15, and 20. Okay, so we need to get the selling price that's adjusted for inflation. So how did we do it? Okay, so how do we calculate it? Pretty simple. Just list down the selling price and the current price as given by the question, which is 10, 15 and 20. And we need to get the selling price adjusted for inflation. So we need to get this and this amount, which includes the 10% per annum inflation. So how do we get from here to here? Okay, so we need to do a bit of working one. Okay, so it's given that we're given $10 in year 1, but this you have to times with the inflation. So this will be 1 plus inflation rate times number of years. So this will be 10 plus 1. Inflation rate is how much? It's 10%. Okay, increase by 10%. So you just put here 10%. How many years? So okay, see, this is in year 1. From current year, how many years has it been? Okay, so sorry, this should not be plus, it should be times. Okay, so 1 plus inflation rate given in this question is 10% for selling price. So you just write the 10%. Okay, how many years has it been from year 1 to current price year? So current price year is year 0 to year 1, 0 to 1. So it has been 1 year. So 10 plus 1.1 to the power of 1, you'll get 11. Okay, second one. Okay, 15 times 1 plus the inflation rate, 1%. So how many years has it been from year 2 to current price year? So from year 0 to year 2, it has been 2 years. So you times 2. So 15 times 1.1 to the power of 2, you should get 18.15. And for year 3, 20 times 1.1, it has been 3 years from year 0, so it's 3, so you'll get 26.62. Okay, so it's as simple as that. So this is the price that you'll use in your NRV calculation. Okay, so moving on. Okay, so moving on to the next area that students might face problem is which discount factor to use. Okay, so if you're given nominal cash flow, then as the name states, use nominal rate. If you're given real cash flow, then as the name states, pretty simple, just use real rate. So what is nominal rate, nominal cash flow? So nominal cash flow means it includes inflation effect. For example, like earlier, we calculated the selling price if we included the 10% per annum inflation. So that means we are taking into account nominal cash flow. So hence we have used nominal rate as the discount factor. Okay, so let's say sometimes question will straight away tell you the nominal rate is 10%, 12%, but sometimes they don't tell you, so you have to calculate it out. So you can calculate it using a formula known as Fisher formula. Fisher formula is just 1 plus nominal rate equal to 1 plus real rate times with 1 plus inflation rate. So let's say the question tells you the inflation rate is 4% and the real rate given is 10%. So now you need to find the nominal rate. So how do you do that? You just plug in the numbers. So inflation rate, just plug it in and just plug it in. Okay, so you just put this into an equation. So you get 1 plus NR equals to 1 plus real rate is 10% times 1 plus inflation rate 4%. So you will get an R equals to 0.144, means you get nominal rate is 14%. So it's as simple as that. Okay, so next. Okay, so the next section is taxation and the timing of the taxation. So usually the part that students face problem is, what is the tax that is to be paid on operating cash flow, and what is the tax benefit for capital allowance for CA, and the timing of these two payments. Okay, so we're going to look at an example. Let's say machine cost is 200,000 and it's on 25% reducing balance or capital allowance. For calculating tax benefit on capital allowance, you'll either be given reducing balance method or straight line method. So we're going to look at reducing balance here. We can do reducing balance. Straight line is pretty straightforward. Should be easier. Okay, so expected life of machine is 4 years. Scrap value after 4 years is 20,000. It means at the end of the 4 years, you can sell it for 20,000. Okay, and corporation tax is 30%, payable 1 year in arrears. So this is the timing. This is your timing. Okay, so what does 1 year in arrears mean? Okay, so for example, now we're going to look at tax payable and operating cash flow. So like the format I gave earlier. So this is your operating cash flow. It means the sales minus all the costs, you'll get the profit for that products. So this operating cash flow, you times the tax rate to get the tax payable. So earlier in the question, it was given that corporation tax is 30%. Okay, so this operating cash flow, you times by 30%, you'll get an amount, and this amount you don't pay in year 1. For year 1 amount, you pay in year 2. For year 2 amount, you pay in year 3. Okay, so do you get it? Okay, so what it means is year 1's tax payable, you pay in year 2. Because the question says that corporation tax is payable 1 year in arrears. Arrears means 1 year later. So year 2, 1 year later, year 3. Year 3, 1 year later, year 4. So for year 1 in year 2, for year 2 in year 3, for year 3 in year 4, and so on. Okay, so that's how it works. 1 year in arrears, 1 year later. Okay, so now we're going to look at how to calculate tax benefit on CA. So we're going to look at a little bit of working. Okay, so first I'm just going to draw a line. Okay, so the year that we have to do the tax benefit for is year T1, which is year T2, T3, and T4. This is because the expected life of the machine, is 4 years. So we have to do tax benefit on CA for 4 years. Okay, so now going back to the question. So T1, T2, T3, then and then here will be tax benefit on CA at 30%. This is the timing of the tax benefit. Okay, so we start with costs, and then we start with the capital allowance, which is 25% as given in the question. 25% reducing balance. Okay, so every year there's a capital allowance, and on that capital allowance we will be having a tax benefit of 30%. Okay, so now let's start. Okay, so the machine costs 200,000. So cost is 200,000. So capital allowance is 25% reducing balance method. So 25% of 200,000 will get 50,000. Okay, since it's reducing balance, every year after the capital allowance, after the capital allowance, we will minus off the capital allowance amount to get the balance, and then the 25% will times on the balance. Okay, so 25% of 150,000 is 37,500. So you keep doing this and you will get 112,500, another 25%. Okay, so 25% of 112,500, calculate, you'll get 28,125. Okay, so you'll get a balance of 84,375. Okay, so when it comes to the final year, the T4, the final year of this calculation, so you have to be careful a bit because you have scrap value here. Okay, so scrap value. Okay, so it's given in the question that the scrap value is 20,000 after 4 years. So you just plug that in, 20,000. Okay, so we know that 84,000 minus the capital allowance, you'll be left with 20,000. Okay, because every time you minus capital allowance, the balance reduces. So 84,000 minus something is 20,000. So what is that something? It is 64,375. So 84,375 minus 64,375, you'll be left with the scrap value. So this is the balancing figure. This is the balancing figure. Okay, so now on this capital allowance amount, all this capital allowance amount, we will have to times 30% to get the tax benefit of 30%. So 50,000 times 30%, you will get 15,000. Okay, 15,000. 37,500 times 30%, you will get 11,250. 28,125 times 30%, you will get 8,438. And 64,375 times 30% tax rate, you will also get 19,313. So the capital allowance amount times with tax rate, you will get the tax benefit. Okay, this is the tax benefit. Okay, remember it says payable 1 year in arrears. Okay, it means 1 year later. So for T1, the tax benefit 15,000. What is the timing for it? 1 year later. So 1 year later of T1 is T2. For T2, 1 year later, you get the tax benefit T3. So for T3, 1 year later, you get a tax benefit 1 year in arrears. T4 and T5, so on. So it'll be like this. Okay, so it'll be like this. So the tax benefit for year 2 will come, it's 1 year later. So something like that. Okay, so that's how we calculate tax benefit. So I'm just going to show you a small extract of how it'll look like when you actually do the NRV question, so you understand better. Okay, so pretend this is the cash flow statement. Pretend you're doing a NRV calculation. So in the NRV calculation, of course, you will have your machine cost and your scrap value, okay? And then you're going to do tax benefit on CA. So this is so that you have a clear understanding, okay? So you have your T0, T1, T2, T3, T4, T5. Okay, so the machine cost is 200,000. So 200,000. The machine costs you 200,000. The scrap value at the end of the machine life, 4 years, is 20,000. So you get 20,000 at the end of the 4 years. Okay, so earlier we calculated 15,000 tax benefit for T1, but you only get it in T2. So you put it in T2, 15,000. Then for T2's amount of tax benefit of 11,250, you'll only get it in T3, so you put it in T3 instead. 11,250, 8,438, 19,313. So that's how it'll look like in a question when you're doing it. Okay, so now that's it. We have gone through all the areas that students might face difficulty. So now we're going to start doing some questions. I hope you all enjoyed the video. So now we're going to start doing some questions. So just head to the part 2 of this video for the questions, and that's it. Thank you. Subscribe if you like the video.